Risk management. As traders, our job is to make money. But just as much as that, our job is to not lose money. And so risk management is a key component to success as a trader or investor. With every trade, long or short, there's 5 potential trading outcomes: a large profit, a small profit, break even, a small loss, or a large loss. So if we can eliminate the large loss outcome, then we're really left with a formula for success where our losses are small and our gains are big. So any losses that we have should be overwhelmed by the profits gained. We're perfectly capable of eliminating this large loss, and it's actually a pretty simple fix. It's using a stop loss on our trades to cap our losses, our potential loss, at a small amount. So why do traders let the large loss trade happen? What prevents them from using a stop loss? Let's take a look at a few reasons why traders blow up their accounts. The first reason is trading a leveraged asset class without proper education. Leverage amplifies the potential gain on a trade, but also the potential loss on a trade. And so getting involved with a leveraged asset class without proper training could lead to a trader blowing up their account. Secondly, a lack of specialized education and continuous mentoring. Good news is you're here taking care of this right now. It's important that we educate ourselves on the financial products that we're trading, in the asset classes that we're trading. When you combine that with continuous mentoring, which will promote the good behaviors and eliminate the bad behaviors, this is only going to help us hone our skill to become successful traders and investors. Not using a protective stop. As we saw, using a protective stop eliminates that large loss outcome. Why would a trader not use a protective stop? What happens is somebody enters a trade, they're not educated in the markets, they might not even know what a stop loss is. And if they're not educated, chances are they're not right on direction either. And so this trade will start going against them. Now, they're human, they don't want to lose any money. And so they don't want to close this trade out because that means that they definitely will lose. They're accepting that they've lost. They're accepting the money that is no longer in their account. And so they don't want to close this trade because they don't want to lose. And what happens is they end up losing a much larger amount that their account can't even handle. It's ironic because to start with, the trader doesn't want to lose, and that's why they don't close the trade and why they don't use a stop. And consequently, they end up incurring a much, much larger loss. Trading without a plan. This is the mistake of most new traders or novice traders, is entering the markets without a plan of what they're going to do, where they're going to buy and sell, how they're going to do that. When you're trading without a plan, you're not trading consistently, you're not acting consistently in the markets, and your decision to enter a trade is generally based on something subjective as opposed to objective. So trading with a plan is crucial to a successful model, and trading without a plan is a good way to blow up your account. Finally, incorrect position sizing. Basically, if you get involved with too many shares or too many contracts, too many trade units, whatever it is that you're trading, if you have too many, your potential loss will be much larger than you had initially planned. Let's review reward to risk ratios as they play a big part in risk management. Risk is simply the difference between where a trade is entered and where a trade is exited for a loss. Now, at a demand zone where we're looking to go long, we're going to place our stop loss just beneath the demand zone. What that's going to do for us is limit our risk to a very small amount. The amount of money that the trade will gain, if profitable, is our reward on the trade. So if price hits our target, then we would be out of the trade with a profit, and that would be the reward amount. On the supply side, we're going to look to enter short or sell short at the supply zone. Our stop loss is going to go just above the supply zone. So this is how we will limit our risk between our entry and our stop loss, which is just beyond our zone. Our reward, where we're going to exit the trade for a profit, should be much larger than the amount that we're willing to risk. So if we look at this ratio between the reward on a trade and the risk on a trade, the potential profits to the potential loss, what we're going to be going for with each one of our trades is at least a 3-to-1 reward to risk ratio. Now what this allows us is to be wrong on 3 out of 4 trades and still end up at a net break even. With this, we only need to be right 25% of the time to maintain that net break even. Just think if you could increase that percentage to say 30%, 40%, maybe even 50%. Now you're looking at a profitable model. So you see, the key to managing our risk is maintaining a small amount of risk per trade. We're looking to cap our losses at a small amount. If the trade is going against us, we're going to cut our losses short. And when the trade is going for us, we're going to let our winners run to their profit target, giving us the proper reward to risk ratio for this successful formula when trading and investing in the markets.